This is lesson 2. What is the stock market and why does it go up and down? So in the last video, we talked about what a stock is. It's a tiny piece of ownership in a company and how to read a stock page, and we used Apple as an example. Today we're going to step forward, and I think it's important to explain what the stock market actually is and how it works, and honestly why stock prices go up and down. So at first, what is the stock market? So let's start with this big picture. The stock market is basically a giant meeting place, but digital. It's where people come to buy and sell shares of companies. It works kind of like a marketplace or an auction. There are different markets or exchanges where this happens. Two of the biggest ones are the New York Stock Exchange and the NASDAQ. So in this image right here, this is the New York Stock Exchange, and then the NASDAQ is right here. That's the NASDAQ. And yeah, so if you're in Canada like me, you might also hear about the TSX, which is the Toronto Stock Exchange. Very similar, it's just nowhere near as big as the New York Stock Exchange, the NASDAQ, and so on. Each exchange is home to different companies. For instance, Apple trades on the NASDAQ, while companies like, for instance, in Toronto, the TD Bank trades on the TSX. The big question is, why do stock prices go up and down? Now, let's talk about price changes, the thing everyone cares about. Stock prices change because of supply and demand. That's it. That is the only reason, supply and demand. If more people want to buy a stock than sell it, the price will go up. On the other hand, if more people want to sell than buy, the price goes down. Think of it like this. Imagine a pair of shoes. A pair of shoes drops that everyone wants. Demand goes up, the price goes up. Same thing with stocks. We could even show it on a chart. This is basic Eco 101. We have the supply factor and the demand. If there are more demand for the object, or well, I guess in this case we're talking about a stock, there's more demand, there would be less supply. And if we look at the price would be right here. So the demand price is here, and then the quantity is right here. On the other hand, if you have less demand, it will cause more supply, which lowers the price, so suppliers can sell the product. In this case, we're not really selling a product, it's more of a share, but you get the idea. It's very, very simple. The next question is, what makes people buy or sell? A bunch of things. There's many, many reasons why people buy or sell stocks. First, big one is company news, like earnings reports or product launches. When there's earnings or earnings expectations are high and the earnings releasing they're good, people see that there's progress within the stock and they're going to buy it. Another reason is product launches. If Apple, for instance, is releasing a new product, we're not going to say like a new iPhone, but we're going to say like a brand new product. Let's say they released a fan, a very, very technologically advanced fan. The product is new. It's very cool. It's new to the market. People seeing this, they're seeing that Apple's growing. They're going to make more money. People are going to buy the stock. The economy, interest rate changes, inflation, unemployment. The higher inflation and unemployment, this all causes people to want to buy and sell stocks. News headlines, global events, wars, elections. Recently we had Donald Trump with his tariffs. It caused the stock prices to all go down because we knew that the U.S. is becoming less stable in a sense. It's also becoming more stable, but we're just going to say it's becoming less stable when it comes to other countries around the world. Companies like NVIDIA and their chip prices has increased, and so people saw this. They start selling to save some money they're making. And even hype or fear. Sometimes people panic and sell, or they have FOMO and buy like crazy. Another thing it's very important to know is, how do you actually buy and sell? You use a trading platform or a broker like Wealthsimple, Questrade, Robinhood, or Interactive Brokers. Now, I mentioned this before last time, but to actually buy and sell, you need to have a broker. You can't just go like in the old days and buy and sell. You need a broker, and it's basically this company that connects to the stocks and exchange, and it's kind of like a middleman. So you place your orders. For instance, you want to buy this many shares of this company. You place your order. The middleman, which is the broker, will contact the stock exchange, and then it gives you the shares and so on. It usually takes a day, one business day, to get that transaction go through. But in short terms, they're brokers, and all of this is done digitally online. Back then, couple of years ago, well, not a couple, but a while ago, this was done in person, you have to go in, it would be a much, much harder process to buy shares. When you place a trade, you usually use one of the two main types of orders. There's a market order and a limit order. A market order is you are buying or selling at whatever the current price is. It's quick, 1, 2. That's the price, that's what you're gonna buy it at. A limit order is a little different. Is you set a specific price and the trade only goes through if someone's willing to meet that price. So when someone's selling a share, so let's say you want to buy this many shares, but a little less than what it's actually going for right now, you put a limit order, and when the broker connects you with someone who's trying to sell that those shares for that price, you will buy them. So that's when the order will go through. So if Apple's trading for at $212, let's say, but you only want to buy 210, you place a limit order. Who's in the market? It's not just regular people like us. The stock market has retail investors, that's me and you. There is institutional investors. These are big players like banks, mutual funds, and hedge funds. We're going to go over those in more detail in a future video. And even algorithms, automated trading bots that make trades in milliseconds. People set up these bots that kind of place limit and market orders depending on whatever code they have running. And you're also playing with them. Everyone's trying to get in and out of the best possible price, and that's why it creates movement in the market. That is pretty much it. This is a very, very short video. Just to quickly recap, the stock market is where people buy and sell pieces of companies, also known as stocks. Prices are moved based on supply and demand. People buy and sell based on news, earnings, emotions, future expectations, and more. And you can place market or limit orders through a trading app or a broker, which is a middleman. That's honestly it for today's lesson. You know what the stock market is, how it moves, and why it changes every single day. In the next lesson, we'll talk about indexes and what they are and how they relate to the stock. And yeah, thank you so much for watching.